Hi, I'm Mike Gitlin. Welcome to another episode of our Capital Ideas podcast, where we get to know the people behind the portfolios. Michael Beckwith is here with us today. He's an equity portfolio manager based in San Francisco, even though he's a Lakers fan. Today, we're talking to Michael about the effectiveness of a global technology research team, the importance of assessing company management, and Michael's own Mike Tyson moment. Michael, welcome to the podcast.
Thanks for having me.
All right, so you have a Harvard Law degree, Michael, but you decided to never use it. Let's just say in practice. You may use it for other things, but you've never practiced. Why'd you get a Harvard Law degree, and why did you never use it?
Well, there's an adage at Harvard that the students that get A's become professors, those that get B's become judges and lawyers, and those that get C's go into business. So,
Okay. So you just gave us your report card.
Right. So I want to thank you for outing my outstanding academic record. No, I did fine at Harvard Law School. But I graduated in the late 1990s. It was really the explosion of the internet. I had worked on a couple projects when at law school, and I wanted to be closer to the center. So I went to a boutique investment bank, Robertson Stephens, and a couple of years later moved to the buy side.
Got it. So your journey to get here, you did that. You did a hedge fund, venture capital. Tell us a little bit about that journey, and then when you got here, what surprised you most?
When I joined Capital 7 years ago, when I was interviewing, people focused on the cultural element. Could someone from a hedge fund adjust to Capital? And actually, that wasn't the challenging piece. But what was a much bigger challenge was the breadth, diversity of investors. Each equity unit has roughly 80, 85 equity investors. And one of the portfolio managers, Carl Kawaja, said, Capital is like the first time when you were a kid and you went to a buffet line and you're like, how am I ever going to get through every station?
Yeah.
And there is an expert on everything, and it takes time to learn how to access that. And I think my first couple of years here, I always was like, I wish I could fast forward being here 3 years, but that is something you have to be in the saddle, you have to travel, you have to go through scenario after scenario.
You joined Lateral, as you mentioned. You were a lateral hire. We have more of those now than we had 20 or 30 years ago. But you have a unique investment process and a unique investment edge. Tell our folks a little bit about that.
So it's interesting when one asks about investment edge, because if you asked me 15, 20 years ago, I think I would have had a very precise answer. And I compare it a little to when people visit China. When you go one or two times, you're like, oh, I understand it. And then each layer you peel back, you realize how multidimensional it is. I think what I do well is I look at questions and companies with a lot of orthogonal perspectives. So that's competitive advantage, that's management incentives, that's culture, that's corporate finance, that's psychology, that's history.
So it's a puzzle.
It's a puzzle. And bringing all those to bear, I think ultimately allows me to allocate capital in a more effective way. And I would say that would be my edge.
And you also talk about portfolios being like wet clay and that they're always being shaped. What does that mean? How should we think about your process as it relates to constructing a portfolio?
So I use the analogy of wet clay and molding because I think the role of and responsibility of a portfolio manager is different than an analyst. And as a portfolio manager, I'm very focused on what is the composition of my returns, what is the pattern of my returns, is the portfolio running too hot, is it running too cold? And the notion of you're always molding and shaping is the market every single day is giving you input on what are the correlations in your portfolio, what are the macro risks you're wearing, how is valuation and risk reward evolving. So the wet clay piece is always, maybe you're chopping off an arm here, adding a new leg here with the goal of producing a return that over the long term is superior and generates alpha, but also with the characteristics that our clients expect.
So it's not as if every single idea that's a reasonable idea makes it into the portfolio. You have to pick and choose because of some of those skews that could come from not thinking about portfolio construction.
Absolutely. And I think one of the elements is in the capital system, an analyst may be very, very positive on an individual sector, but perhaps that sector also correlates exceptionally closely with another sector. So, for example, over the last few years, electrical equipment that help with the data center buildouts correlate very closely with semiconductors. So asking what is the best risk-adjusted expression of things that I'd like in the portfolio.
And you talk about, and maybe this is the contrarian in you, but you talk about underappreciated or underinvested assets, maybe unloved. So how do you think of those assets? What you need to see some form of catalyst for change to put it in the portfolio, but that in effect makes you a contrarian.
So ultimately, as investors, our job is not just identifying great businesses, it's businesses that are mispriced for change. And that change can either be cyclical or it can be secular. And one example of what I would put more in the structural or secular camp of coming out of 2022, we were leaving a period of very loose monetary policy, free money, and a lot of industries really got spoiled and ruined by free money.
Mm-hmm.
So a couple companies that I was invested in, Carvana, which is a used car marketplace, and Uber. I think the industries did not present their real economics because free money incented irrational behavior.
Zero interest rate policy. They could borrow so cheap, it didn't have them have real fiscal discipline as a corporate entity.
Right, and their competitors.
Their competitors.
And so once we went into 23, 24, and you went through a period of capital starvation, I think the economics and the competitive dynamics and their advantages came to bear. And I think those advantages were lying in plain sight previously, but they were obfuscated by the free capital. So that's more on the structural change. On the cyclical change, for example, our semiconductor analyst has been very positive on the semi-capital equipment cycle. And for 3 years, we've been in a down cycle. TSMC, their capacity is getting tighter.
Yeah.
Memory prices are at their all-time highs. And it's a little bit been like waiting for Godot. And he's been articulating it will happen. And so right now, I think we are in the early stages of the semi-cap equipment cycle, which will last for several years.
And part of the capital system, my first interview in this podcast was Rob Lovelace, and his investment edge, he said, was time. The 8-year number driving the primary quantitative bonus being giving him the time to be right. This is like that. You can start building those positions in that sector a year or two earlier than others, build a reasonable position when others then are chasing it when it becomes more commonplace.
That's exactly it. And I think another adage at Capital is maybe you want 1/3 of your portfolio doing really well, 1/3 compounding and doing its thing, and 1/3 where you're planting those seeds, the sectors or companies that really generate significant returns a few years out.
Yeah, I love that. That's a great way to frame it. One of your jobs here, we ask people to do 5, 10 jobs. One of your jobs is cluster head of technology. So explain to folks what's a cluster as it relates to Capital Group, and how does that work every day?
So I think clusters are really one of the underappreciated secret weapons at Capital. So what a cluster is you will have a group of analysts in adjacent industries. So you might have the media telecom and the semiconductor, the IT services, the software, the hardware. And then you'll have PMs in the cluster that either potentially used to be technology analysts or are very interested in technology. Clusters are really analyst-led, very consistently with the core ethos of Capital, that the analysts are the heart and lungs. But I think PMs can really help zoom out, and we call it look at the global warming questions as opposed to telling the weather questions. So we'll travel together. We'll do trips in Asia. We will do very focused trips in the US. And it's really that creative and intellectual friction of both PMs and analysts coming together to think long term.
So I'm guessing you and your co-head and analyst, you'll sort of get together and think about the topics for that day. Someone brings up the topic and everybody weighs in. Does one person own that segment? Just bring us live into the meeting on how it actually works.
So I'll give an example from this morning, which was not specifically in the cluster, but I think is a good example. So right now in the market, we are seeing broad swaths of industry sell off very aggressively on concerns that they potentially are AI roadkill. So this is asset managers,
real estate, commercial real estate,
insurance brokers,
wealth management,
data services, e-commerce. And so we were focused on an individual subsector today of info services, and the analysts that cover the stocks would discuss them. PMs would engage in, very active debate and questioning. We were trying to isolate the first principles of what business models and competitive advantage appear sustainable and where it may prove more temporary. So, and this was an hour-and-a-half conversation, very focused on a few companies, but having the perspectives of multiple people helps just create an important intellectual friction, which I think is important to serve our clients well.
Yeah, that question on AI, whether it's enhancing a business or disrupting a business and how positive or negative on it, feels like it's sort of shoot first and ask questions later. And you're trying to get through that and say, well, what is real here? What's really going to be impactful for this company or this sector? And what might be a bit noisy, but over the long term, they've built enough of a moat where their business is still a good one. Is that a?
I think that's very fair. I think the one piece that makes it harder, whether you've been doing this for 30 years or you've been doing it for 3 years, is minds naturally work on linear progression. And so a lot of the question is, I can see what are the AI products and services in the market today, but what will they look like in 2 years? Mm-hmm. So it really does require pretty expansive thinking to ask what business models may change. And I'm a believer that a new technology architecture or technology shift, that doesn't necessarily pose risk. It's when new business models are really created outside of it. So we saw it, with Uber. You see it with Airbnb. The cloud created a new set of business models. It allowed for companies like Spotify to emerge. So really asking where are new business models going to emerge and pose competitive threat.
Yeah, that's a great way to put it. I want to talk about China. Last year, you spent some time there. I think it was the first time you were there since the pandemic, and you had some great takeaways. Can you share them? You talked about AI, autonomous vehicles, a bunch of things. What was your last trip to China like?
So I went last spring, and the trip was a whirlwind, 5 cities, 12 meetings a day, very focused on AI, robotics, and autonomous vehicles. And the conclusion that I wrote when I returned was, as a U.S. investor for the last 5 years, one was not penalized by not thinking about China that actively. And I said, I think that time has changed. And so I think the conclusions were a couple-fold. One, obviously, coordinated policy in China is a really important driver of change. And with the DeepSeek moment, it was very clear that both provincial and the central government was taking a very different view of technology. And when you are an enabler versus putting up obstacles, that really changes the game. The second is, whenever I've been to China, the entrepreneurs, there is a spirit and a work ethic that is really unparalleled. And it's common 996, that you work 9 a.m. to 9 p.m., 6 days a week. You might want to change it to 997 because that is the intensity the companies are putting on that. And in AI, they are accomplishing a lot with so much fewer compute resources that I think it's very significant. And also, you couldn't help but think about global policy that export restrictions, I think, will ultimately produce local champions in China. And then both with robotics and autonomous vehicles, what we've seen is China has an amazing way of optimizing supply chain, reducing costs, lowering manufacturing costs, constant improvement. And the cost structure differential versus US and Western peers is so profound that I think we will see what we saw in smartphones when we get to robotics and AVs.
So did you visit BYD on this trip?
I didn't see BYD on this trip, but I saw a lot of the autonomous vehicle companies.
I haven't been, and you can tell us because you were there. Apparently, the technology within these auto plants is dramatically different than it was 5 years ago or 10 years ago, and even different than what you see in the US. What did you see on the ground?
So I think that's exactly right. I remember going to BYD, it was probably 2012 or 2013. And I went in right after I went to the Ford factory, and it was the sort of the Stone Ages versus a modern manufacturing plant. And I think that has totally flipped. That automation is very high. The process technology they use is really advanced, and also a constant focus on reduce costs, reduce costs, reduce costs.
So you can't avoid China anymore. You could avoid it 5 years ago, 3 years ago, but today you have to find the right companies.
Exactly.
Company managements. Varying degrees of focus on that from our investment professionals. Everyone thinks it's important. Some people think it's the most important thing. Other put it in their sort of 8 or 10 pieces of the puzzle. Where are you in terms of company management and how important they are in you owning a stock?
For me, it's fundamental. So on the scale of 1 to 10, it's probably a 9.5. When we look at what are A-plus managements, it all comes down to culture. Just as at Capital Group, it's hard to really say what's the secret sauce of culture. It's focus. It's how quickly does bad news travel. It is long-term incentives, and it's really focusing on a critical few variables. And everyone seems to be singing from the same hymnal on those companies that get it, and on those companies that have less focused management. You'll talk to 5 different executives, and it's almost that you're talking about 5 different companies. So I think it's incredibly valuable.
So will you own a company that's in a great space that you think that has the right products, let's say, but you don't love the management? Will you still own that company?
I will see if there is a company that has similar characteristics with the management I like. There are times that the tailwinds are so great in an industry.
Even a bad management can't hurt it?
Right. For some period of time. So would that be a company that you likely hold for 10 years? No. Would it be something that maybe you hold for 2 to 3 years? Yes.
And when you come out of a meeting and something came up in that meeting that raises this yellow flag, did you say, I can't believe they said X? It's beyond just one person saying something and someone else saying something else. That's obviously a problem. What other things come up where you lose faith in the company management when you leave the meeting, you say, this is just not one I can count on?
I think one of the things that is a flashing yellow light verging on red is a company that's too obsessively focused on their stock price. I think another one is, I do think the view that show me someone's incentives and I'll show you their behavior really matter. And when you see suboptimal incentives, things that don't include return on invested capital are all about earnings growth without a notion of what is driving that growth, those tend to be red flags. And a smaller one for me is in executive meetings where you have the CEO, CFO, head of marketing, an ops person, and you'll see which CEOs feel like they have to answer every question. For me, that signals it's not an empowered culture. And so that would be a pretty flashing yellow light.
These are good ones. What opportunities you see in the market today? It could be industries, companies, anything, but what do you see out there?
So to the notion of you're always, there's wet clay and, molding a portfolio right now, and I think it's a function of when we're speaking, a lot of very good businesses have gone on sale about concerns around AI. So Microsoft and Amazon are trading at market multiples for the first time in 10 years. That is largely on the view of the market is concerned that the huge investment cycle is not going to have a strong return on invested capital. I think companies like Google, Microsoft, and Amazon will be that trusted gateway. I think all those companies understand the investment dollars they're putting in the ground, and I have confidence that we're going to look out in 3-5 years and that they will be borne out. And the other areas which we talked about are whether it's the rating agencies, which have gone down 20 to 30%, whether it's insurance brokers. The market is, as you said, shooting first, asking questions later. And so we're doing a lot of work on where do we want to lean in.
You talk about Microsoft and Amazon and Google, and at one point the market was concerned that they had too much cash, and then the market became concerned they're making too many AI investments. Are we going towards that middle at some point? Because it is, I think, between Microsoft, Meta, Amazon, and Apple, I think combined they were making 500 or 600 billion of investments into capacity, into AI capacity, this 1 year alone. Is there a number to you that's too much? I mean, I think people view long-term the payoff will be there, but these are huge numbers and a dramatic change from them hoarding cash.
I think you're right. They used to be wildly free cash flow generative, and now they're break even, marginally free cash flow positive. And for businesses like Microsoft that have historically returned capital via the dividend and buyback, the question is that potentially a better use of your excess cash? And I think there are a couple things. One, when you have a technology shift of this proportion, I think they recognize when we think about our franchises on a 10, 20-year basis, unless we are a leader, then we actually might have declining cash flows.
Right.
So there is a bit that is necessary, and particularly in technology, and I think it's a good question of what is the multiple you should pay for a technology company, because there is always persistence and obsolescence risk, and they need to be making these investments to make sure that they don't look like a mainframe company of 25 years ago. But I believe they're doing it from the front foot, and I think we will see in 3 years that the investments were prudent.
Yeah, that makes sense. You and I were talking on a shift to lessons learned. We were talking, and you talked about lessons learned having a Mike Tyson moment. So for those folks who are not boxing fans or Mike Tyson fans, either one, what was that moment? What's the punch you didn't see coming?
The famous Tyson quote is, everyone has a plan until they're punched in the face. And there is nothing like when you wake up as an analyst or a PM and you have a stock down 40% or a group of stocks down 40%. And when we have new joiners, whether it's MBA or our Capital Associates program, which is our program for undergraduates, I always tell them, once you learn the technical skills, the much more demanding piece of the job is the emotional constitution side of the business versus the analytical side. And so one of the things I like to do is when I initiate a new holding, I have a little Excel journal where I write down the 2 to 3 business KPIs that I think are really important to track a thesis. And secondly, I'll write what change in the company fundamentals or competition or regulatory would make me sell the stock.
Right.
And having a bit of a pre-plan when things get really real and you're punched in the face and you can't really breathe, I think is helpful to make better risk-adjusted decisions.
Yeah, that's great. I mean, putting that down there on paper, hold yourself accountable for what's changed from the thesis I initially had. I think that's a great way to think about it. Mentors, 1 or 2, who's helped you in your career?
I'll highlight one person outside of Capital and a couple people inside Capital. So when I joined Robertson Stevens, Green Bean, didn't know much. My first boss was Eric Yupin, and he said within my first week, For hard work and loyalty, I'll give you a career, which means I'll teach you, I'll fight for your career advancement. And for me, that was the best trade ever. And I think if I can pay that forward to others, it's something I always think back on. And in terms of mentors at Capital, I'll highlight a few. So, and you've had them on your podcast. One is Martin Romo, who's our chairman. Another is Chris Bookbinder. Both of them took a bit of a flyer on bringing me into Capital because there were fewer lateral PMs at the time. And they're just they're a compass. They're a constant guide of, okay, you can push a little harder. You've learned Capital enough. And whenever I'm questioning myself, I can always go to them. And the other person, we have a neat little program for all new people who join called an open door, which is a program where you can ask that person a question that you felt was too stupid to ask of anyone else. And Jessica Spaley, who's a portfolio manager, was mine, and she's always so thoughtful, so sober, a great person. And having those people in your corner make a huge difference.
She was on this podcast as well. It's a good safe zone person to have. If you're given advice, what would you tell both a lateral hire and an analyst who's joining new?
What I frequently tell earlier career analysts is, one, be patient. Two, trust the capital system, that our actions match our words and our incentive system. So if you blow up in a stock, it's not the end of the world. Learn from it. I think another thing that's important is that mistakes are not a bug. It's a feature of improving as an investor. So, be patient. The other one, which I think is important, is, and I used to have this on my wall that said, you are not your P&L. So it is really easy to internalize your mistakes as an investor, and being able to understand sort of your value, your purpose outside of just how you're succeeding or going through a tough period is really important. And then maybe on laterals, I would say, one, listen carefully, listen thoughtfully. And after you've done that, we realize not every great idea was created here, and you were brought here to make a contribution to make Capital better, so don't be shy.
Yeah, learn and teach both. Yep, love that. We're going to finish up with our obsessively grateful moment where I'll give you the mug.
Thanks.
What are you grateful for, Michael?
So when I thought about the question, I was going to mention my family, which of course I'm grateful for. But last night I flew down to Los Angeles, visited my parents who've lived in the San Fernando Valley for 60 years. And my father, he's 88. He is declining physically, and it is a challenging period in his life. But everything he says and does, he shows grace and gratitude and optimism. And I thought it's a great metaphor, not just for life, but for being an investor. And if I could show a fraction of the grace, gratitude, and optimism in challenging times, I think I'm going to be a better person. So I'd like to highlight my father.
Well, that's a good lesson for all of us. I think that's a great place to leave it. Thank you for joining us. You made a big difference here, so we appreciate it.
Thanks so much, Mike.